Hello, everybody. Greetings from Manila. And on behalf of the chairman of ACRAA, Mr. Masuda, and the vice chairman, Mr. Fahim Ahmad, and all the other members of the ACRAA board, I would like to welcome my friends and colleagues in ACRAA. Today, we start a series of webinars on updates in capital market developments in countries represented in ACRAA. And we are starting with China and India. In a world of both more complicated and more complex, and that certainly includes our own world of financial markets, we need some assistance to somehow make sense of all the fast evolving developments around us. We know that this matters, but how exactly? How do they particularly impact on our working assignments? This afternoon, this morning, this noon, we shall listen to two speakers from among us who have picked out certain aspects of the capital market development in their respective countries. As we shall see, they paint broad scenarios, but with highlights of specific information. We have left it to their discretion to choose what to highlight. But all of us participants will have the opportunity at the question and answer session to raise our own questions, to pursue the information we think are of more relevance or interest to our respective concerns. We'll try to make the best use of the time we have. Knowledge is power, as I always say, and sharing knowledge is the path to reinforcing the knowledge power we already have to be better equipped for our own work. And that's what ACRAA webinars and seminars aim to accomplish. In the question and answer session, the questions will not just be directed to the speakers, but the speakers themselves can direct questions to the participants. For example, to make comparisons. They made their presentations about India and China. They might ask you, Mr. Chong, how does it compare with Malaysia or Thailand or Japan or the Philippines? So it's going to be a, what they call this, a multi-pronged question and answer period, and let us get to be more involved and make the best use of our time. I would like to invite Faryal to just explain to us the arrangements for the question and answer, because she's our technical director, anchor, etc., etc. Faryal, please, some house rules.
Sure. Good morning, good afternoon, everybody. Welcome here today. Simple house rules. As always, keep yourself muted during the session. If there is a question that you do want to ask during the presentation is going on, chat has been enabled. Please do write there, and the participants as well as the speakers will be able to see your chat and respond to your chat. We do have a designated question and answer session, which Mr. Santi will be announcing. I would appreciate if all of you may raise your hand. As you know, on your control panel, you will have a raise hand icon. Please do raise. We will be calling each and every one of your names, and then you may pose your question to the speaker, and we will let you have that opportunity. Besides that, you can chat with me directly in case you're having any problem while you're posing questions or you'd like to ask anything. I shall be available throughout, and I hope that we have a great session today. Thank you, Mr. Santi.
Thank you, Faryal. there are any further questions later on, we can raise them during the question and answer period. And now may I proceed to introduce our speakers. The first speaker will be on the capital market of China. And I would like to introduce Ms. Christine Zhang, Executive Director, International Business Department of China Tianjin International Credit Rating. Excuse me. She's responsible for rating analysis for sovereign and multinational institutions, as well as bond rating. And I underscore this for myself because the Philippines, for one, has been seeking to tap the panda bond market for its own particular needs. Ms. Yang is also a member of the Credit Rating Committee in CCXI and CCXAP, responsible for panda bond and offshore bond rating, and that's quite a wide latitude of responsibility. She has worked on the research of local government debt and sovereign rating, and she has been leading the research of panda bond rating framework as well as global scale rating methodology. Her team has undertaken most of the panda bond cases since 2015. She earned her bachelor degree of economics, master degree of macroeconomics from Renmin University of China. But I would like to mention for myself an addition. Christine belongs to that elite group of young professional Chinese women making their distinguished mark in the financial markets. And we are proud in ACRAA that she is one of us. Let us welcome Ms. Christine Zhang for her presentation. Christine, please take over.
Yeah, thank you, Ms. Danlo. Thank you for your introduction. Hello, everyone. This is Christine from CCXI. It's a great pleasure for me to give this presentation covering the development of bond market and credit ratings in China. So let me share my screen. So I consider this as great opportunity for me to exchange views with our fellow members about the bond market and rating business. So in this presentation, I will not only give a general overview of the involvement in China's bond market, and what's more important, I will show you how the rating business in China started and grew. And you know that there has been recently some new policies targeting this industry. So I would like to give you a brief overview of these recent changes. So first, we know that the history of Chinese bond market could be traced back to the 1980s. While there has been a few developments considering the limited size and the single products for quite a long time, the Chinese bond market has gained rapid expansion only after 2005, especially over the latest 5 years. And up until now, the Chinese bond market has become the second largest market globally, with the total bond market size of 117 trillion RMB in 2020. If we look at the credit bond, namely those bonds except from Treasury, Policy Bank, and Financial Bond, the size has reached 15.21 trillion RMB in 2020 from 223 billion in 2005, with an annual growth of 33% on average. The rapid expansion of bond market actually led to the leaping development of the rating business in China. So next, I will introduce to you about the the two different markets in China. So you know that there are two major bond markets in China, the interbond and exchange market. The two markets used to be divided in terms of different regulatory requirement, players, and products. In terms of outstanding volume, the interbond bond market accounts for 86% of the overall Chinese bond. However, over these years, with further opening up of the Chinese financial markets, the interconnection between the two markets are being enhanced through multiple ways, and they are moving toward merging into one unified regulated bond market. The issuers of Chinese bond market have gradually expanded from the early state-owned enterprises to private enterprises, foreign enterprises, and overseas institutions. And in terms of the industry, it has expanded from the early traditional industry, for example, the infrastructure and the electricity, to the current emerging industries, such as cultural creativity and information technology. Meanwhile, since 2005, the bond market has successively launched various kinds of innovative products, such as asset-backed securities, convertible bonds, exchangeable bonds, and green bonds. Along with the diversification of issuers and products, a complete Chinese credit rating system gradually formed. The globalization of RMB and for the opening up of financial markets has brought new opportunities to the Chinese bond market. So we're talking about the opening up of the financial market. So on one side, the Chinese bond market is also further opening to attract foreign issuers since 2015, gradually forming the namely so-called panda bond market. And with relaxation of type of issuers and a more friendly issuance requirement, the panda bond market is becoming more aligned with the international mechanisms and further pushing the upgrade of the infrastructure of the local bond market. And on the investment side, by the end of 2020, nearly 900 overseas institutions have entered the interbond bond market. The scale of RMB bonds held by overseas institutions reached 3.2 trillion RMB, an increase of 54% compared with the end of 2019. And the Chinese RMB denominated government and policy-backed securities were included in the global indexes consecutively. In terms of the rating industry, further opening up has also promoted local rating agencies to operate in the Hong Kong offshore market. At the same time, the international big three rating agencies were allowed to operate in the local market after 2018. But despite the continuous opening up, the total amount held by foreign investors is merely 3%, and foreign investors rarely consider the credit bond. So it's important to know that the Chinese credit rating are still operated in a local scale, which is different from the international scale. So next I will introduce the credit performance of this market. And after the financial crisis, the ratings were gradually applied in market operation in different ways. First, as the threshold of bond issuance. The PBOC, NDRC, and the CBRC once regarded external rating as an important element of public bond issuance. While in recent years, the threshold of issuance has been relaxed. However, under the requirements of investment and risk management, it is still difficult to see any public issuance below AA. The second is the investment threshold of financial institutions, normally stays above AA, most often seen in those set by the CIRC and the CSRC for insurance companies, securities companies, and funds. The third is the reference of risk management. For example, entities with below AA ratings can rarely pledge repo transactions. And if we compare the rating spread in 2020 with 2008, it's clearly seen that a much concentrated rating above AA is gradually formed. In 2008, issuer rating above AA is merely 56% of the total, while in 2020, that number has reached almost 87%. But does this reflect the real credit performance of this market? the answer is clearly no. In fact, the defaults accelerated over the recent years, which I will introduce later. So how did this happen? And this is also the most often asked questions by the foreign investors. And from our point of view, there are several ways to track the reasons. Next slide, please. So the first, there is a unique issuer structure of onshore bond market. The outstanding onshore issuers are around 5,500, in which the non-financial issuers accounts for more than 80%, and the financial institutions is 16%, while nearly 85% of the onshore issuers are state-owned enterprises. If we look at the total issuance volume in 2020, nearly 92% of the issuance come from state-owned enterprises. And that structure determines the fundamental credit performance of this market is highly concentrated because the majority of the issuers enjoys the implicit guarantees from the local and the central government. Next, please. And also the local investor structure is quite imbalanced. As I mentioned previously, the proportion of foreign investors is quite low, which means local Chinese investors dominates. The investors in China's bond market are mainly institutional investors such as banks, insurance companies, and funds. Among them, the most important bondholders are commercial banks, which accounts for 57% in terms of scale, followed by funds and wealth management products, the two in total accounting for 86%. At the same time, there has never been a real default for quite some time in China's bond market, which made the investors less sensitive to credit risk changes. Meanwhile, due to the investment threshold, the investment behavior is also homogeneous. The imbalanced investor structure and narrow default market determine that the overall investment risk performance of the market is low. Next, please. Also, the fierce competition inside the rating agencies drives up the ratings. With the expansion of the bond market and the increased demand for rating agencies, for rating services, the local rating agencies have expanded from the initial 4 to 5 to the current 15, and the rating agencies has extended from the early issuer pay mode to the current both issuer pay and investor pay mode exists. Competition is growing inside the industry, considering that the number of rating agencies in China is far more than that in the United States. As rating is mandatorily required, most rating agencies are issuer-oriented, and they would pay more emphasis on expanding the market share instead of reputation build-up, which constantly leading to the rising of ratings. Next, please. But that situation has changed. Since 2012, China's economic development has entered the so-called new normal stage, and its economic growth has transited from a high-speed growth period to a medium high-speed growth period. And in order to stabilize economic growth, China has taken many rounds of credit expansion after the financial crisis, which is called the counter-cyclical management. And in the process, China's overall debt scale has been growing. According to the BIS statistics, by the end of 2020, China's debt scale is second only to the United States, and the proportion of China's debt scale in global debt will further rise to about 20%. High debt level leads to higher sensitivity to the change of credit environment. Next, please. So let's take a look at the defaults in China. The Chinese bond market has experienced 2 rounds of default before the COVID-19. In 2014, the first default happened, and the long-lasting rigid repay is broken. From 2014 to 2016, the first wave of default happens in those private enterprises of overcapacity industries. The second round of defaults started in 2018, and the number of defaults in private enterprises and listed companies increased. Since 2020, under the impact of the pandemic, years of debt accumulation plus the impact of the epidemic has led to the deterioration of business operation. With the exit of the loose monetary policy, the risk is further exposed. Since the second half of 2020, the number of new defaults were significantly higher than those in the first half of the year. Especially the unexpected defaults of large local SOEs has hit the market. So far, we think the defaults in China has entered the stage of normalization, and that leads to the layering of credit risk and the diversification of investor preference, which further increased the need for risk differentiation. While if we see the current rating spread is further concentrated in AA and above, and recently there even appears the inversion of credit ratings and defaults in some cases. So the role of credit rating is not fully played. And this roughly explains the background of the recent credit rating reform. Next, please. On March 28 this year, PBOC, NDRC, MOF, CBIRC, and the CSRC, the 5 major regulators, jointly issued the notice on promoting the high quality and healthy development of the credit rating industry in the bond market to solicit public opinions. We consider this of great significance to promote the standardized development of the credit rating industry in the bond market, enhance the quality and the competitiveness of China's credit rating, strengthen the risk prevention of the bond market, and promote the credit rating industry to better serve the overall situation of the healthy development of bond market. Next, please. The other important step is the abolishment of the mandatory rating requirements. On February 26, the CSRC issued 2 administrative measures targeting the issuance and the trading of corporate bonds and credit rating business in the bond market. The former one abolished the mandatory rating requirements for public issuance of corporate bonds. The latter one explicitly cancels the mandatory rating requirements in registration. In March this year, NAFMI explicitly canceled the requirement of a mandatory disclosure of issue rating in the issuance process. So under these policies, the mandatory rating requirements for issue rating is canceled, while issuer rating is still needed. Next, please. So I'd like to make a brief summary here. So first, the history of credit rating in China is not that long compared with the international markets, and it has gained explosive growth along with the Chinese bond market since 2005. The rating spread in China is becoming increasingly concentrated over the years, which could be attributed to several reasons. The unique structure of onshore issuers and investors, the threshold of investment and risk management, the zero default history, last but not least, the fierce competition inside the rating agencies resulted by the rapid expansion. So each one is playing its role. Well, since 2012, with the shift of economic growth in China, things has gradually changed. Risk is accumulating with the credit expansion and the slower economic growth. Especially since 2014, the rigid repay is broken and defaults happens in various kinds of issuers, from private enterprises to listed companies and to large local SOEs. The layering of credit risk appears, which calls for the differentiation of credit ratings. So then we are seeing the regulatory policies landed to change the situation. Next, please. So the recent policies are reshaping the future of the rating business in China. At present, the regulatory authorities are forming a joint force on the reform of weakening the dependence on external rating, which will help to promote the transformation of China's rating industry from regulatory-driven to market-driven. But from our point of view, it will take time for the local rating agencies to adapt to the new environment. And in fact, not only the rating agencies, all the market players need to rebalance for the latest changes. And from the perspective of the rating agencies, for now, at least some trends are becoming more clearly. That is to further differentiate the credit rating spread, to improve the quality and the forecast proficiency of the ratings, and also to be more investor-oriented. And we do believe that these measures will bring huge opportunities to the healthy development of rating in China, and also benefit those foreign investors who would like to invest in Chinese bond market. So thank you. This is all my presentation. So I apologize for the mistake in terms of displaying the presentation. So I look forward to discuss with all of our members should you have any questions.
Thank you very much, Christine, for your presentation. We now go into our question and answer session, and we will entertain questions from anybody and everybody in this webinar addressed to Christine. I have, in fact, I have several questions, but let me just limit myself just to one right now. And I'm trying to understand the thinking of the regulatory agencies. Could we go back to that slide on mandatory ratings requirements abolished?
Just doing it, Mr. Santi. Just one, give me one
Yes,
second.
yes, we'll wait.
Sorry. Is it this one?
Yeah,
Yeah.
Yes.
Yes, yes. Christine,
Mm-hmm.
here we see that the mandatory rating requirements for the public offering of corporate bonds
Mm-hmm.
have been abolished. So,
Yeah.
yet they want the authorities are suggesting that we strengthen the credit rating, the China credit rating agencies in the performance of the duties. I see a little bit of inconsistency here. You're strengthening the credit rating industry, and at the same time, no, it's not required. So there must be a reason to this. So what is it, Christine? So we can understand what the Chinese regulatory agencies are doing, and perhaps start comparing it with the other jurisdictions.
Yes, so thank you for your question, Ms. Damlo. This is actually a little bit difficult for to understand, I think, from your perspective, because you know that the Chinese credit rating industry is so unique that, as I have introduced, it grown and expanded with the growth and expansion of the Chinese bond market, and this market is highly regulated. And it's also, the Chinese credit rating industry is also highly regulated. As you know that, as I have previously introduced, that there used to be a threshold in terms of issuance, and it has been relaxed. But currently, you can still hardly see any issuance below AA ratings, and that could partly be reflected by the investment threshold and risk manager threshold. So we know that the threshold is set by the regulators at the beginning of this market when it started to actually foster the credit rating business, because it set the threshold and it said that the rating requirements is mandatory. So the credit rating business actually explode along with the bond markets, the growth of the bond market. But problem also comes along with the threshold and the mandatory requirement. As you know that First, the further concentration of this credit rating above AA. We can hardly see that this has no correlation with the threshold. This must be something correlated with the threshold. But on the other side, as rating is required, so for the rating agencies, they would put more emphasis in terms of expanding the market share, in terms of, trying to build up their reputation. So mandatory rating requirements actually, it did bring a lot of the steady growth and revenues for the rating business, but at the same time, it also brings a lot of the problems, like the concentration of the ratings and how the rating, how the rating agencies behave, because they put more emphasis on the issuer perspective in terms of the investor perspective. So it resulted that with the further concentration of the current ratings, it does not play the role of risk pricing. So the external credit rating cannot fully show the differentiation in terms of the risks of the issuers. So I think that's why the regulators are determined to first counsel the issuance rating of the bond market, but issuer rating actually is still required so far. So I do know that the regulators, they're taking their way. They know that this is not a simple and easy way to change the situation, but they can move step by step. But they do believe that to first abolish the mandatory requirement of credit rating is the essential step to further differentiate the current rating, to change the behavior of current rating agencies, to make it more market-oriented instead of regulatory-oriented or issue-oriented. So could this roughly explain this question? Yeah.
Christine, thank you. But Fahim, Mr. Fahim Ahmad, were you listening to the exchange of our conversation? What is your take, Fahim?
Yeah, it's still, I was just listening, and I had a luxury of looking at this kind of noting down these changes in China through other means. Also, I was tracking China, but I still see a problem here, because if you abolish suddenly the ratings, and then if the ratings are not demanded by the investors, because you see, if you look at the global market, the ratings are demanded by the investors. And where it was such a heavy regulatory intervention, how would the investors demand? I think in Malaysia, I still wonder. Santi, remember,
Yes.
Malaysia also abolished the regulatory requirement on ratings on the bond market, and
That's
they
right.
left it. I think there was a dip in the market, which I understand from RAM and MAR. But here, when the bond market is developing, but I think there is an intelligent way from the regulators that they still require the issuer rating, maybe, just to know the capacity of the payment, how the behavior of the historical behavior of the ratings are playing in favor or not in favor of the issuer. So I think they have detached this and tried to maybe go away from the concentration, which a lot of concentration in the Chinese market, and a lot of defaults in highly rated bonds. So I think this could be a balance they are trying to do.
Christine, has this matter been raised by the credit rating agencies of China as a group, as a concern, or did you just accept it as it is?
Certainly, it must be a major. We do consider this as a shift in terms of this credit rating industry, because the Chinese credit rating agencies, they're so comfortable with their current business profile, their current business operation, how they just need to, because rating is mandatory required. So and also the market keeps growing, the Chinese bond market keeps growing. So I think when the so-called the abolishment of the mandatory rating, all the rating agencies, they need to find the new business mode to how to keep these rating agencies to operate, as Mr. Fahim has just mentioned. With the abolishment of the issuance rating, actually the pay, we got cut quite a lot in terms of the payment. So we need to think about how to change from the issuer pay mode to be more investor oriented, to make our ratings more important to the investors. So this is a new situation we need all to adapt to. But this is also game theory, that there are so many rating agencies in China. As I mentioned, there are 15. So how do we combine our strengths, or just how do we balance each other's profit to maintain like in terms, for example, in terms of differentiating ratings. Once we differentiate the ratings, will the other rating agencies, they keep up with our step? So this is a major problem that we are concerned of. And also in terms of the payment mode. So will we raise our payment level? So these are the questions I think they are all confronted by all the rating agencies in China. Yeah.
But look at, sorry, Santi, but Christine, look at the requirement of the entity ratings. So they are keeping this as mandatory. So it means you will have some play in the debt market, because without entity rating, you cannot issue the debt in any case.
Yes, but it also, it affected our revenue performance, because the loss of the issuance.
That is not tied to the quantum of the bonds. Yes, because your fee would be related to the quantum of the bond, the size of the issuance. But now it is only the entity.
Yes.
Definitely. Yeah.
It's the problem.
I hope you wanted to join the conversation.
Yes.
In fact, I will also say that it could be a potential move in terms of the shift of the entire revenue model of a rating agency from an issuer pays to an investor pays, primarily because in case of a regulatory driven requirements, mandatory requirements of rating, the issuer has no choice but to tap at least one rating agency or more than one, depending upon the requirements. And that sustains the issuer pays model. But the moment the mandatory requirements are done away with, then it's entirely left to the choice of the investor. Because see, if there is no requirement, but still the investor would anyway would be interested in knowing the creditworthiness, the debt servicing capability of the issuer, and they in turn would potentially could be tapping the rating agency of their choice into doing this. So while globally the issuer pays model has been dominating, but I think this subtle shift in the requirements potentially could be driving the revenue model of a rating agency from issuer pays to investor pays. That's what my understanding indicates.
Yeah, so but even that, even the second one, the lower portion of that screen, Christine, even the requirement for disclosure has been removed, and this is very basic. I mean, unless I don't understand your presentation, disclosure is minimum. So I don't know whether the investors, if there is no rating, would invest. So perhaps if I may connect this conversation with that slide of yours on implicit guarantees of local government. Can we look at that, please?
Sure, I'll just put it up.
The slide. the
Yeah,
I think it was before this.
the
When we
issuer,
talk about
issuer
implicit
structure
Sorry, just one
Before
second.
that.
One second.
before that.
we talk about the implicit guarantees of
Issuer structure.
Issuance structure.
Yeah, page 7. Yes, before that.
yeah, no,
Before that. Before this one. Yeah,
no, not
Is
this
that
one.
okay?
yeah.
You were talking about implicit, yeah, this one. When you say the fundamental credit performance of this market is highly concentrated, as the majority of this enjoys the implicit guarantees from the local and central government.
Yes.
Implicit is not really, well, the opposite is explicit. So, but is it a real guarantee? I don't think it is meant to be that way. And perhaps because the Chinese investor just relies on the implicit guarantee from the local and central government that they think they don't need to have a credit rating. So this reinforces everything. This the requirement for mandatory rating, abolishing that, just pushes the investor to rely more on these implicit guarantees. Perhaps we have that experience that the government will bail them out. So I don't know. It's that's precisely why credit ratings are around, you know. So I am bringing this up because this is something I think that ACRAA as an industry should discuss. And if this is the model for other jurisdictions, I think there would be no need for credit rating agencies, and that would really eliminate the independent credit opinions that the market requires. So that's just my take. I'm mentioning it for the record. We probably can discuss it some more in our other ACRA forums. Are there any other comments on this, please?
Yes, Mr. Santi, Mr. Asiful Haq wants to ask a question. Mr. Asif,
Yes,
can you please unmute yourself and you may ask your question?
Yes, please.
Actually, it regards to cancellation of the mandatory rating. What is the reaction of the international investors with respect to cancellation of mandatory ratings of corporate bond? Christine.
So may I repeat your question? So your question is
Actually-
about how the foreign investors. see
Actually,
this
I want to know how the international investors react with respect to the cancellation of mandatory rating of corporate bond in China.
Yeah. So as I mentioned, that the foreign investors, when they invest in Chinese bond markets, they rarely touch the credit bond. So they only invest in those treasury bond and policy bank bonds, because one of the major problem is that they can't rate the local ratings. You know, they can't differentiate them. So you know that some of the local issuers, they also issue the offshore bond, US bond in Hong Kong, and the big three rating agencies, they make there's a huge differentiation in terms of the ratings. So they find it really difficult when they're investing in the onshore credit, onshore RMB bond. So that's one of the problems. So I do think that when if we are determined to further differentiate the current local skill rating, that will definitely benefit those foreign issuers to try to build a more, a rating that is rateable, that to the foreign investors, because we have exchanged the views with the foreign investors, and they consider this as a good sign, a good step to start with. But in fact, this must take a long way. We do not consider this as something that will happen so soon, because once there is massive downgrade rating actions, there will be a
Faryal,
huge
will you just take over for a while, please? I'll excuse myself just for a while. Take over, Faryal, please.
Okay, okay, we're here. Thank you.
So
Yes, Christine.
yeah, so we do think that it's good. This will benefit the foreign investors, but to the local investors, I think they will suffer from the changes in terms of the ratings once we're going to differentiate these local scale ratings.
But Christine, I also wanted to ask you that since you also mentioned that there is a lot of international investment which is coming into Chinese bonds, right? You mentioned on your first slide. So
Yes.
doesn't that mean that in any case, the international investors would be seeking the bond ratings, and then that would just make sure that, you know, people do get their bonds rated in any case, because it would not be possible to attract an international investor without a bond rating.
Yeah, but the foreign investors, I think, as I mentioned, they rarely consider the onshore credit bond. So that are the bonds that accept from the Treasury and Policy Bank bond, because they find it difficult to rate the local scale ratings, as I mentioned. So that's also why the big three, they're entering this market, and they're trying to give a more, you know, for the differentiated ratings. But there's also a problem in terms of their localization, because the Chinese issuers and investors, they can't adapt to their scale because they're so widely spread. But we do not consider that this is inconsistent with the credit performance of these local issuers. As I mentioned, maybe almost 90 of them are state-owned enterprises. So we do not consider that they deserve such low credit rating performance. So that's I think there's a balance between the local rating agencies and the international rating agencies. So each of us need to maybe rebalance for appropriate relative ranking of the local players.
All right, thank you. Any other questions, please? We do have a little bit of time if anybody would like to ask anything before we move on to India. All right, thank you, Christine. That was extremely insightful, and I think there was a twist in it that we were not expecting, that you would tell us that, you know, mandatory ratings have been removed, and so, you know, I think it really brought in a lot of interest, and I think we shall continue with you on the topic later on as well. I think Mr. Santi is just off for
Thank you very much,
Are you
Faryal,
back?
for taking over. Yes,
problem.
as you can see, Christine, you have stirred a lot of conversation. I have a lot more questions actually, but let's go now to our next speaker. I would like to introduce a very good friend, a really good friend, Mr. Mehul Pandya. He is the head of CARES business in India and abroad, as you can see, and he's providing the tactical impetus. I like that word, tactical impetus. That means everything. Tactical impetus to CARES operations. And he has been with ACRAA since 2000. And that's in the credit rating industry, more than 20 years. He's a CFA charter holder from CFA Institute in the United States, chartered financial analyst. He is a true-blooded technocrat, a frequent presenter in many credit rating forums, international forums, ACRAA forums. But most of all, I'd like to introduce him as a very good teacher. I have listened to him personally, face-to-face, in conducting ACRAA training seminars in New Delhi. I don't remember the place, Mehul, but it was somewhere outside of Mumbai.
Yeah.
Yes, and he's not only a teacher, he loves to be a teacher. So let us welcome our teacher for this afternoon, Mr. Mehul Pandya, Executive Director of CARE Ratings Limited.
Thank you, Santi. I'll share my presentation first.
Yes, please.
Yeah, good afternoon, everyone. I hope the presentation is clearly visible on the screens for everyone.
Yes, it's fine, Mr.
Yeah.
Mehul. Welcome.
Thank you.
Thank you.
Thank you. First of all, my compliments to Christine for a very comprehensive presentation, which gave us a lot of perspective on the Chinese capital markets, especially on the debt side. And as Mr. Santi, Mr. Fahim, everybody rightly pinpointed, I mean, this is an area of concern in terms of the regulatory developments over there, diluting the requirements of the rating, because as the people representing, professionals representing rating agencies, and that also with the full commitment towards the development of the capital markets, we firmly believe that we indeed are providers of the requisite value addition when it comes to the informed decision making by the investors. So I would like to believe that this could be an aberration, and the requirements of ratings would sustain across the Asian countries. With that, I'll just begin with my presentation. First of all, it's a wonderful opportunity, as always, to connect with everyone at ACRAA. Through this kind of sessions, we get the benefit of having the insights from each one of us. It's a wonderful forum all along. And certainly, I think it will go from strength to strength, even in this kind of challenging times. In this presentation, I'll be covering the recent developments in India's capital markets, which includes the equity, debt, and the mutual fund industry. And I have also tried to capture the trends in the primary markets, secondary markets, the equity indices, the cost of borrowings, so on and so forth. Towards the end of my presentation, I have also tried to do a bit of a comparison of the Indian and Chinese capital markets. As we all know, capital markets are critical to the economic development of a country because they indeed provide the necessary requisite financial resources from the long-term sustainable development of the economy. As far as India is concerned, various segments of the Indian capital markets, they have witnessed notable growth over a period of time. Talking on the equity markets, they have increasingly been seen to be determining the pace and pattern of India's economic growth, and they have indeed led the transformation of the financial framework of the economy. On the other side, the debt markets also have been largely dominated by the government securities. I mean, that's one area where India indeed needs to change the pattern going forward. And because of that, the corporate bond market is comparatively undersized. So the government and the regulators have been taking various reforms to deepen the corporate bond markets. But we indeed have a long way to go before we can say with pride that the corporate bond markets are really vibrant. On the other hand, the foreign portfolio investors, the FPIs, and the mutual fund investments into the capital markets, they are also important barometers for the growth and development of the domestic capital markets and the country's balance of payments as well. So first, we'll take up the equity market. So as the couple of graphs on the screen shows, Indian companies, they have resorted to tapping the equity markets even during the two most challenging years, beginning from the end of FY20. So FY20 in itself was a challenging year because we started seeing the impact of the COVID, especially towards the last quarter. And of course, FY21, without any doubt, has been one of the most challenging years for the economy globally. So despite this pandemic-driven hardships, corporates have raised record amount of funds aggregating in, if I were to put it in the dollar terms, it's almost like close to $13.5 billion US, which is 35% more than the previous year. So of this, the rights issues, they comprised a significant portion of this. as compared to the initial public offers. So while the initial public offers, the IPOs in the last 3 years, they have seen a steady pickup from around close to around $2 billion in FY19 to around $5.5 billion subsequently. But this composition of rights issue was outpacing the IPO issuances in FY20 and also in FY21. So the key equity issuances in FY21, in terms of the rights issue, that was by India's largest corporate entity, the Reliance Industries, which aggregated to close to around $7 odd billion, and a follow-on public offer FPO by another private sector bank, which is Yes Bank, and which was close to around $2 billion. So these large IPOs that included one from the pharma sector and another from the government infra sector. The responses to these IPOs during the year was buoyed by the robust listing of the stocks. As far as the secondary market trading is concerned, so the turnover of the Bombay Stock Exchange that was close to around 128 to 129 billion US dollars, which was quite high as compared to what it was then in the financial year 20. The movement in the Sensex, which is the Bombay Stock Exchange comprising of 30 stocks, that had declined substantially in March 20, primarily because of the uncertainties which the market was apprehending because of the onset of the COVID pandemic. Well, it had reached a significantly high levels by that time, but March 20 saw a steep decline. However, there has been a subsequent consistent improvement in the Sensex levels, and that was driven by the optimism surrounding the overall global economic recovery, and also the policy thrust given by Government of India and the regulators aimed towards tiding over the pandemic-driven volatility. Talking about the foreign portfolio investors, the FPIs in the equity market. So the net FPI equity investments in FY21 that stood at a significantly higher level of $37 million. And this strong inflows, they were tempered to a certain extent by the record outflows in March 2020, which was no surprise considering that there was a lot of uncertainty going into FY21. So the net FPI equity inflows that witnessed a dip in the beginning of FY21, right, on account of the fears of global recession and the increased demand for the safe haven assets. However, the FPI investments picked up subsequently with the gradual opening of the economies, especially in India. The economy started getting opened up towards the end of May 2020, and in a further gradual manner subsequently. In September 2020, India witnessed a huge withdrawal to the extent of almost like $860 million on account of the weak economic prospects. Since the COVID pandemic, they were surging all across the country. So the equity segment, while it had received significant inflows till that time, it saw an outflow in September 20. However, by November, the hopes of economic recovery again gained momentum, and we could see the inflows reviving. So the large borrowing by the government as planned in FY22 to boost the overall economic prospects, and the higher US Treasury yields to some extent that weighed in on the FPI flows during the far end of the fiscal 21. Some key regulations in the primary equity markets, it revolves around the differential voting rights, which were introduced by the regulator in India. It enables the superior voting rights to the founder promoters. Especially, it is helpful in the startups, the tech-driven companies like that. And it is crucial for the tech companies to retain power with the founders and the promoters and prevent dilution of their rights. The other aspect was the innovators growth platform, which was for listing of the companies involved in certain segments like data analytics, biotechnology, e-commerce, etc. So that initiative was an attempt to boost the startups once again. Another aspect was in terms of the insolvency and bankruptcy code, where several relaxations under corporate governance norms, exit option to public shareholders, they were given to the companies for the corporate insolvency resolution process. The regulator also reduced the time period for the listing of the issues. So it was reduced from T+6 days to T+3 days. There were introduction of the unified payment interface, the UPI. A new payment mechanism for the retail investor applications was also introduced. So this is likely to benefit the issuers as well as the investors by making the shares available at a faster rate. And one aspect was in terms of the easing of the norms for the buyback of the shares. So post buyback, the debt to equity ratio could be around 2:1. And that was one change which was introduced by the regulator. On the secondary equity market side, one thing which stood out was the operationalization of interoperability framework, which was aimed at boosting the efficiency and ensuring cost effectiveness by facilitating clearing and settlement of transactions at a single clearing corporation, regardless of the exchange on which the trade was executed. This was one change which was introduced by the regulator. As far as the mutual funds were concerned, the regulator allowed investors to tap the stock exchanges also over and above the distributors, which were the primary source of getting investments into the mutual fund industry. So now it is allowed to the stock exchanges as well. Another aspect which was there pertained to the cybersecurity. And then one key aspect is in terms of the consolidation of 4 existing capital market laws. So in the last budget for the government that the government of India introduced, they proposed to consolidate 4 laws into a single securities market code. So which will be helping in terms of smoothing out the various overlapping parameters of the various laws which were in place. Measures have also been taken to strengthen the algorithmic trading and the co-location proximity hosting framework, which all are aimed towards facilitating the small and medium-sized members. Turning to the debt markets. The corporate bond issuances have seen a steady growth. So right from FY19 onwards, and even prior to that, but specifically from FY19 onwards, it had scaled record high issuances. And the corporate bond issuances, they aggregated to a fairly large extent as compared to the previous years, almost 10% higher than the previous year. And more than 90% of the debt issuances, they were via private placement. And that's one aspect where probably a lot of work needs to be done, primarily because we don't seem to be having too many public issues of debt. So that's one area where Government of India and the regulators, they need to work upon. The healthy growth in FY21, as we can see, that was on the back of the long-term repo operations, LTRO, and the targeted long-term repo operations, both of which were introduced in early financial year 2021, which was in the first quarter beginning from April to June. And these aspects were introduced so as to ensure that there is enough availability in the market for the corporates, since the banks could have been wary in terms of lending to looking at the apprehensions surrounding the asset quality. So with these measures, the Reserve Bank of India, it helped in terms of providing the necessary impetus to the banking sector to further lend to the corporate sector. So the weighted average cost of borrowings, they declined over a period of time. So one aspect in FY21 that you can see is the decline in the yields has been supported by the consistent accommodative policy stance, monetary policy stance by the Reserve Bank of India. In terms of who dominates the corporate bond issuances, there are no surprises. The financial sector continues to do that, with almost 68% of the total corporate bond issuances in the financial year 2021. This is followed by roads and highways, power generation, oil exploration, like that. There are other players, other sectors which could be seen, and they include steel, cement, but not to a significant extent. And one aspect which stands out is that 46% of the total issuances have been raised by public sector undertakings, which is a clear indicator of the fact that the entire revival for the economy is at the behest of the government and the public sector in undertakings. We are not witnessing too much of a private sector investment. And one of the reasons, of course, is in terms of the sluggish economic prospects over the last few years. And over and above that, we are also seeing that there is the capex formation in the economy that has stagnated. And that is one of the reasons why we see the public sector dominating and the government's efforts in terms of pump ramping the economy through its own expenditure. In terms of the secondary bond market trading, the things have moderated marginally in the last financial year. The 10-year GSEC has eased from 7.4% in April 19 to 6.14% in March 20, and has remained broadly range bound in the entire fiscal 21. So ease of 10-year GSEC was on account of the various rate cuts which were introduced by government, by Reserve Bank of India through its sustained accommodative monetary policy. However, the large market borrowing program by the government and the low appetite for the investors, they have kept the 10-year GSEC yields elevated in FY21. The bond spreads, they have also marginally declined during the last 2 years, making it moderately cheaper for the corporates to raise funds from the bond market. So this has also been substantiated to a significant extent by the liquidity support and the policy measures by the regulator. In terms of the FPI outflows, we have witnessed some volatility. So they aggregated to close to around $13.8 billion during the last 3 years. And in FY21, the FPI flows in the debt market, they have been very volatile, and over the last 6 months with significant changes in that. There has been outflows from the debt market in the last 3 years, primarily on account of the changing interest rate scenario in the Western countries, with investment opportunities looking better that drew up funds from emerging markets like India. So these concerns, they were further elevated due to the fiscal deficit concerns at the Government of India level, and also the debt levels of the government during the last fiscal, which was coupled with the lack of appetite on the part of the investors for the corporate bonds, and also due to the limited liquidity which was available in the market. Some key regulations in the corporate bond market. Foreign portfolio investors, they are allowed to invest in the unlisted debt. There is to the extent of around close to USD 5 billion. The FPI limit that has been raised as far as corporate bonds are concerned. So earlier it was 9%. Now they can go for up to 15%. Brokers have also been allowed to undertake repo and reverse repo contracts in corporate bonds. There has been a repo platform for the corporate bonds which has been introduced. So at both the stock exchanges in India, so they introduced that thing. More importantly, the large corporate borrower framework, both by the capital market regulator SEBI, as well as the banking regulator Reserve Bank of India. So this was something which was absolutely warranted to give fillip to the corporate bond market. A market which has witnessed a significant overcrowding by the government borrowings, indeed required a significant push from the regulators. And in a country where more than 50 to 60% of the total credit is coming from the banking sector, the time was ripe in terms of regulatory intervention in a positive manner to deepen the corporate bond market by necessitating tapping of the corporate bond market by the large corporates to meet their financing needs. So the thresholds were changed. But I would like to also add that even consequent to that, the things, they have not improved to a significant extent, primarily because after these frameworks they were introduced, India did witness a lot of volatility and completely unforeseen development in terms of the COVID-related pandemic. So that has also led to a significant extent the investor appetite only towards safe havens. Turning to the mutual fund industry, the total assets under management, they were close to around $430 billion, which was quite high as compared to the previous year. And 47% of the total assets, they were dominated by the debt segment, and 31% was, close to 31% was for equity segment. The Indian mutual fund industry that has significantly recovered from its low level, and the volatility which was witnessed in the beginning when the pandemic started, I think slowly and gradually the industry has recovered from that. So there was a significant steep fall in AUM in March 2020 due to the possible impact of COVID-19. But after that, there has been a sustained recovery. The total outflows were close to around $4 billion in FY21. At the aggregate level, the mutual fund industry has also witnessed overall outflows during the last 4 months of the last fiscal, while consistently realizing the inflows in the initial months. So the increase in the equity AUMs has been on account of the increasing valuation of the portfolio of the stocks that they were holding. If we were just to look at the scheme-wise composition of the AUM in terms of equity and debt, out of the net assets of around $137 billion of equity mutual fund AUMs, the largest share continues to be the large cap funds, followed by flexi cap, ELSS, and the other funds. In case of the debt mutual funds, the liquid funds continue to have the largest share, followed by the corporate bond funds, the short duration funds, and the other funds. I've just done a small comparison of the Indian and Chinese capital markets. So despite the COVID-19 pandemic, there has been record equity issuances in both the Chinese and the Indian equity markets. But as is getting depicted, there's actually no comparison between the sheer size of the Chinese and the equity, Indian capital market, Indian equity market. The proceeds raised from the Chinese equity linked markets for the full year of 2020 was a close to around 90% increase as compared to the same period in the previous year. So it was one of the strongest annual period for the Chinese equity capital markets. And in the number of equity issuances that also grew by a significant 73%. Compared to that, India's equity issuances continue to remain a small fraction of Chinese equity issuances, but they still grew at a reasonable pace of around 29% during the last 2 years. The total number of initial public offerings, including the first-time offerings issued by China-domiciled companies, raised an amount equivalent to almost 125 billion US dollars. This was almost 86% of the previous year. On the other hand, during April to February 2021, there have been more rights issuances. In case of China, the equity issuances in 2020, they were dominated by sectors like high technology, industrials, healthcare, financials, and in case of India, it was dominated by oil and gas and financial institutions. The market cap also is a clear indicator of how favorably the Chinese equity markets are poised. So the market cap of Shanghai Stock Exchange is almost at 45% of the GDP, which can be reflective of the fact that there could be further potential increase, which the investors could be expecting over there. As compared to that, in case of India, it's little more than 100% by the end of fiscal 21, which potentially could be indicative of the fact that probably in the markets, they are poised for some kind of correction. The size of the bond market in China is almost double to that of India. And it has been growing at a steady pace as well. The size of the bond market in India actually fell by around 15% in fiscal 2020. And then it has increased to some extent in fiscal 21 to December. The Chinese bond market issuances during the calendar year 2020 is 47% higher than 2019, with 5% growth in case of Indian bond issuances. So more or less, as we can see, both in terms of equity capital markets as well as on the debt capital markets, Chinese economy is significantly better placed as compared to India. And that's no surprise as well, because the way China has led the growth globally, and not just talking about Asia, but globally. So that's a clear reflection in terms of how the capital markets are also a clear reflection of that. So this is something which I tried to capture in terms of the developments in India and a small comparison with China. Thank you. I'll be happy to take questions.
Thank you very much, Mehul. Thank you very much for your presentation. We now go to the question and answer session. So while the participants are perhaps getting ready with their questions, can I raise the first question, Mehul, on private placements? That's slide, I think slide number 11.
Okay. Sure. Should I share that?
Private placements.
Okay, should I share this screen? Should I share this?
90%. What was that?
Yeah, I think he wants you to just share it, please. Thank you.
Okay. Okay, this one, slide number 11.
No, it's yeah. That's right. That's right.
Hmm.
More than 90% of the issuances is via private placement.
Right.
What do you mean? What is the meaning of private placement in India?
See, private placement would mean that it's a bilateral arrangement between any investor and the issuer, rather than tapping the public for that. So private placement is that, see, if issuer company ABC wants to tap and it has just tapped an investor XYZ, so that's a direct dealing by both of them. So they don't tap, and the public issues in this regard, that is through tapping the market through the public. So that's how the differences are there. This is a one-to-one kind of a transaction with one or more investors which could be at play. So there is no involvement of either the debt segment of the stock exchanges or anything in this.
So they are
Is
not
there
listed.
any when you say
Private placements
private,
also could be listed. Private placements could be listed. Private placements could be listed. But in terms of tapping, so this is the differentiation between a private placement and public issue is that public issue is to necessarily tapping the retail investors for this, while this would be a purely institutional investor, a bank, or any other player who could be potential investors into the debt.
Private placed debt can be traded also.
It can be, the private placement can be listed and get traded. Yeah, that is there.
Okay.
is there any limit to the number of investors to a private placement?
No, not to my knowledge.
So you can, a private placement can have, let's say, 500 investors, 1,000 investors.
Yeah, while there could be no limit, but at the same time, it won't be going abnormally high. Primarily because the moment you are talking about a private placement, so you're tapping a small set of potential investors who could be taking up the entire portion of your debt issuance.
Is there a requirement for private placement issues to be credit rated?
Yes. See, on a bilateral basis, if the investor is okay, that's fine. But see, if there is public issues are to be necessarily rated. But in case of private placement, the requirement would be in terms of if it's increasing beyond a certain threshold, right? Then the investors, they do demand the rating on that, right? So generally, in case of India, we have seen that anything more than 1,000 million Indian rupees, so the rating requirements do kick in.
So the threshold is in the value or the amount?
Yeah,
Of
so
the total issue?
generally the requirement would be hovering, say anything which is a meaningful amount, as I mentioned. So then the investors, they do demand the debt to be rated.
So it means
The point of my question really, Mehul, is that with that number of that percentage of issuances in private placement, whether they are escaping, so to speak, the scrutiny of a third party opinion?
See, private placements, we hardly see any unrated paper getting listed on the debt segment of the stock exchange. Most of the private placements, they have got listed on the stock exchanges, the debt segment of the stock exchange. That's number one. Second aspect is that, see, in certain sectors, say for example, the real estate sector, where the issue size potentially could be lesser than the amount which I mentioned, and at that time, and because the rating could be on the lower side, we may not be seeing the something which could be in the public domain per se, right? So it could be, say, a sub-investment grade rating, which could potentially could have been assigned to that sector, the issuance in that sector, and essentially then it would not be getting reflected. But more or less, for anything above the threshold which I mentioned, I think the investors' preferences, they do kick in, number one. And the second aspect also is that, see, the appetite of the investors is also for the higher rated papers. That goes without saying. And a rough estimate indicates that probably the overall AAA and AA rated categories, that could be anywhere between 60 to 70% of the total issuances. And so from that angle, the investors, they clearly would be drifting towards the better rated papers. And that's why, in a way, that could be an impediment in terms of the overall development of the corporate bond market. Because if you really see the number of entities who would be rated, say, in AA or AAA, in terms of the overall rating dispersion across the Indian rating industry, that won't be that high. And despite that, they would be dominating to the extent of 60 to 70% of the overall corporate bond issuances. So that's a clear dichotomy with which the bond markets, they tend to operate. And unless and until something is done to correct that thing, we may not be seeing significant upheaval in terms of deepening of the corporate bond market.
Okay, I will give an opportunity to the others to ask their questions.
Sure.
Any questions, please, from the others?
Yeah,
Sir, I have one question. That is, your major corporate bonds are actually held by the financial institutions. Is these bonds are issued for the regulatory capital treatment purpose, that is for tier 1 or tier 2 capital, or for the regular business expansion of the financial institutions?
Could you identify yourself, please, when you ask the question?
This is Asiful Haq from Chief Trading Officer of CRISIL, Bangladesh.
Okay. Yeah. So let me just segregate this aspect into two sets of borrowers. See, when we talk about the financial institution, essentially the non-banking finance companies, which would be tapping these markets to the corporate bond markets. Now, in their case, indeed, these proceeds, they go in terms of furthering their business growth. Right? This second aspect would be when you are mentioning about the tier 1, tier 2 capital, that's for the banking sector. So the banks, once they tap these markets, it's clearly for the lower tier 2 or upper tier 2 or the perpetual bonds in India, as we segregate them, or the Basel III compliant bonds. So all these, they are going towards the regulatory requirements in terms of how the overall composition should be looking at. Right? So it's from that. And the corporate, the clear corporate borrowers, that means the non-financial corporate borrower segment. So once they are tapping these markets, it could be for two reasons. Number one is in terms of meeting their financial needs for their business growth. And second could be in terms of the refinancing requirements. So their earlier rated, the earlier debt issues could be getting refinanced as and when the cheaper opportunity presents itself in terms of tapping the bond market. So these are the different dimensions.
This is Fahim Mahul. Thank you very much for your very, very extensive. You have covered a lot, but you just tackled one issue on the deepening of the bond market in India. Yeah. Remember 2 years back, you mentioned something about the threshold of the debt equity ratio, where the large corporates were asked to tap into for the disintermediation from the banking system. And you just commented that it has not had what envisaged, it did not occur because not. Yeah. But is it being followed like in a book, the debt equity? And what was the threshold of the debt equity? Was it 2.5 or 3? I don't recall. What was the
2.5? Around
2.5. Okay, yeah. Now how many? So are they going for the private placement now? And is it a group lending or a single corporate lending? How do you define the exposure to the banking sector where they were asked to get? Because this is a very unique law. In Turkey also, I had given a presentation on this, the Indian thing. And I think with the China also, we can write from the ACRAA, to develop this kind of a unique regulation.
Right. I'll just tell you, see, as per the framework devised by the capital market regulator, SEBI, so they made it mandatory for the corporates to meet 25% of their financing needs through the bond markets. And this was applicable to any corporate, excluding the banks, of course, which on 31st March 2019 could have had an outstanding long-term debt borrowing to the extent of 1,000 million Indian rupees. And they were to have been rated AA and above. So this was applicable on that angle. On the other hand, the Reserve Bank of India, they also came out with an exposure framework, and they segregated into some aspects like this. For single counterparty, the sum of all the exposures of a bank to a single counterparty that should not be higher than 20% of the bank's available eligible capital base at all times. And as far as the group of the counterparties are concerned, that means at the group level, the sum of all the exposure values of a bank to a group of connected counterparties should not be more than 25% of the bank's available eligible capital base at all times. So that was the difference. For a single counterparty, 20%. For the group, at the group level, it was 25%. Similarly, the bank's exposures to the single non-banking finance company was restricted to 15% of the eligible capital. And for interconnected NBFCs or the group of connected counterparties, it was restricted once again to 25% of the tier 1 capital. So this was how the capital market regulator and the banking regulator, they had defined this aspect. But when I said that it has still not resulted into a significant deepening of the bond market, is also because of the fact, let's see, because of one reason or the another, the corporates, they did reach out to the regulators expressing their inabilities. And one has to understand on that count that the economy in India has remained sluggish over the last 2 to 3 years. So if you really look at the corporate balance sheets, they haven't got strengthened to a significant extent. And when the rating requirements are as they are, so from that angle, the overall benefit that they could be getting by tapping the corporate bond markets, that was unlikely to be there. And the overall ratings, but they were also under pressure. If we look at, say, for example, in case of CARE, we come out with our modified credit ratio, which is upgrades and reaffirmations to downgrades and reaffirmation. So that was having a clear decline in 19 leading to 20, and just slightly moderated upwards towards the end of 2021. But all these aspects in terms of continued pressure on the corporate balance sheets, their credit quality, they all led in terms of a sluggishness which was getting displayed. And to that extent, I think they were also helped by a bit of the flexibility available at the part of the banks, that just in case if they were not tapping, right, in that case, there was only some kind of a marginal increase in terms of some additional cost that they were to bear for non-compliance. But that was insignificant in terms of having any kind of bearing in terms of the plans of the corporates if they decided not to tap the corporate bond market and continue to tap the banking sector for their requirements.
Oh, very good. Thank you very much. Yeah.
Thank you, sir.
Any other questions, please, from the others? Any more questions to Mehul? Then let me ask Christine. Christine, in the presentation of Mehul, do you see any very significant differences? Any significant differences you notice in the what do you call this? In the capital development directions of India and China? Are they so different, similar,
Yes.
or
So
nothing noticeable?
yes. So first, I think this is very insightful. But I can also see that India's capital market is really quite different from China. I think they're different in many ways, both in equity markets and in the bond market, in the debt markets. Because you know that I noticed that Mr. Mahal only compared the corporate bond, right? So is the so I'd like to ask Mr. Mahal if there's only this kind of products like the corporate bond, they take the majority of the debt markets. Are there any other kinds of bond products?
Okay, see, corporate bond products, they could be segregated into different aspects. One, of course, is the long-term bonds, which are issued by the corporates, and medium to long-term bonds. In India, we define anything in excess of anything with a longer tenure of more than 3 years. We define it as long-term. So the long-term instruments issued by the corporates. Then the structured finance segment also that forms a part of this securitization. So that is also a part of the overall corporate debt market. And of course, anything less than or up to a year, that is the short-term end of the things, and essentially dominated by the commercial paper segment. So everything combines into the overall corporate debt or bond issuances.
Okay, thank you for that. I think I do need to maybe take more time to learn about from this PPT to further compare the differences between the two markets. But so far, I could see there are many differences in terms of the two markets.
Right.
Okay. I'm entertaining some more questions, please, from the participants.
Yeah, I can just comment.
Either
Santi,
Mahal or Christine.
excuse
Yes,
me,
yes,
can
please.
I make a comment here for Christine and India? See, look at the China has been dominated by SOEs over so many years, and India had seen the corporates to thrive, and and there is also what I notice here. If you look at the global economy, if you study USA, the total capitalization. Now I'm coming to another. I'm sorry, I'm just getting so many thoughts. The capitalization of the market in USA is nearly about 100% of their GDP, if I'm not wrong. The total capitalization of the New York stock market, and how about India? There was some numbers here, but China should be getting bigger now over the years because of and catching up with India, these percentages. Although a comparison between of the GDP may not be very apple to apple, because China's GDP is very huge like USA, and then comparing India has a very different economy actually. So that was my comment, to compare apple and apple, the number, the size of the bond market, and maybe the percentages could be better, but the size of China and USA can be compared maybe, but percentage wise India has a very different and a very unique economy and the bond market.
You're right. In fact, and you're bang on target when you say that India and China in this aspects, they are simply not comparable. I mean, China certainly deserves to be in the league in terms of comparison with the US or the other economies. It was just that this was the thing oriented towards a comparison, so an attempt was made. But certainly, I mean, both on equity side as well as on the debt capital side, China is way ahead.
Ahead in terms of the size actually, but if
Size
you look at
actually,
the
absolutely
efficiency,
right.
right now China may not have that efficiency like India. And because India has been very well entrenched in developing the credit. I'm talking about the credit rating agencies now. India is very well entrenched into the credit rating, and now if the China comes in, I think they will have a very good space and a very good platform. Maybe they have to reorient. What in my experience, I think the Chinese rating agencies, the top rating agencies, can reorient themselves and getting into their act and putting the act together and bringing out new products.
That's right.
Okay, some more questions. Chong, are you there? KS Chong? Chong from RAM. I wanted to ask him a question in relation to Christine's presentation. Well, if none, anyway.
He's
So,
not- Anybody
well,
from Mark, perhaps Mark can comment on the Malaysian ratings now after the easing of the regulations. I
yeah,
don't see anybody Mark also actually. It becomes very important.
Well, I
Malaysia,
think in the next session we do have Malaysia as one of the countries, so I'm sure we'll get to compare at that time.
that could give a very good, because that could lead to the Chinese experience actually. The
Yes,
deregulation
yeah.
China has now done what Malaysia did 2 years back, 3 years back. So what are the, now the current situation in Malaysia? So we can now discuss that with the China.
Yeah, that's exactly the question I would like to raise to Malaysia. Yes, because I noticed we have the similar paths. And yes, we know what happened in Malaysia after the release of the requirements. So maybe we can expect it next time.
yeah.
Yeah, Christine, by the information,
Mhm.
me and Santi have really gone to Malaysian regulators
Mhm.
to ask them, to encourage them not to do the deregulation so fast. So
Oh,
maybe
okay.
we can work with you and go to the Chinese regulators to
Yeah,
do it in
we
No,
right rather than deregulated.
appreciate
I,
it.
I really raised that question because I see an entry point for ACRA as an credit rating industry to really dialogue more, engage more our regulators. We used to do that in the earlier years, but that faded because then we were really new, as a lot of domestic credit rating agencies were new and just trying to survive. And even in China, the domestic
Yes.
rating agencies also struggling. But now we're
Yeah.
more established. But we have to have some clear common agenda
Mm,
about what is the role of credit rating agencies.
yeah.
But not just for credit rating agencies to determine that, but also for regulators to determine that, and also for institutional investors to
Yeah.
determine that.
Yes.
So, and then I was going to ask Chong about Malaysia because some recently they said no need for credit ratings. I don't know whether it has worked out, whether it has improved the situation, or whether it is improving the situation. So these are issues, Fahim, and all of us in ACRA, we should raise to ourselves in our subsequent forums. And I mean this year, I'll try to develop an agenda. So as I listen to all of you, I'm trying to develop the points that need action as an industry, not as individual national jurisdiction domestic credit rating agencies. And then perhaps, Fahim, we can also check with our European counterparts, because our European counterparts are the ones who really have so much more engagement with the regulators, because the regulators are very, well, in a way, in my opinion, very restrictive, very restrictive. And yet, the countries in Europe have different situations, but they have one regulator. So many issues, and I'm taking note of all of this and bring it to our attention and put it on the table. If there are no more questions at this point, I will not yet adjourn, move to adjourn, and we will have opportunities to discuss more.
Is
I
it
am
possible, sorry, Mr. Santi, is it possible that everybody switch on their camera so that I can take a photograph, if that's okay? Of all
okay,
the
yes,
participants?
I wanted that. I forgot all about that. Can everybody get in? Sarah, you're rather dark there. Put more light.
Yeah, whoever can switch on their camera, that's fine. We'll then crop it up.
Ay, Masuda-san, Mr. Chairman. Hello, Kip.
Yeah.
You're also dressed up for the occasion, Kip.
All right. Thank you. And thank you very much, everyone.
Okay, everybody.
Lovely. Thank you so much. Now, Mr. Sant, you may
Looks like
continue.
you look like you're going to a party. Mr. Chairman, I intend that the next updating, I will invite Malaysia and Thailand. Kip, please take note. Tris, is Sakda here? Is Sakda with you, Kip? No, you're muted.
Yeah, I just take note for him.
Yeah, I'd like to tell you already, we will ask Tris to make a presentation on the capital market of Thailand. And I will ask Malaysia, I will ask Chong, so that that will be the next. That will be June 25.
Okay.
Is the scheduled date. We can move it if required, but as of now, it's scheduled for June 25. Okay, Kip?
Yes, yeah.
Mr. Chairman, would you like to say a few words and close our webinar? You are there all the time. You're muted. You're muted. Masuda-san.
You are muted. We can't hear you. There is some issue with his mic.
But I believe he's no longer with us here. Oh, there he is. Hang on a second. We tried to.
Is he on?
We can't hear him.
Maria?
Yeah, he's here, but I can only request him to unmute, so he has to unmute from his own end. Mr. Masuda, can you
Masuda-san.
unmute yourself? Yeah, you'll have to unmute, please.
Masuda-san. Seems like he's having problems.
No, yeah, I think he can't, his mic is maybe not working. Okay, Mr.
Well,
Santi, I think you can.
Okay, he has technical problems, and okay, Mr. Masuda, we will leave you to your Olympics problem for now. And it is now my pleasure to thank everybody. Thank you very much, Christine. Thank you very much, Mehul. Thank you especially also to my partner, Farial, my technical anchor, and to everybody who attended. It has been very interesting, and this is what we're going to do more and more. So many things to talk about, really, but we must end. So again, thank you very much, and see you
everyone.
in our next webinar.
Thank
Thank you very much.
Thank you. Take
Thank
care.
you. Thank you. Goodbye.
Mehul,
Good.
I think I missed the sad news about your father. My condolences, Mehul.
Thank you. Thanks for the kind words. Yeah. Thanks.
Same from us then. And
Yeah.
prayers.
Thank you. Thank you.
Our condolences, Mehul. Our
Thank you.
prayers go to you and your family.
Thank you so much.
Okay.
Take care.
you.
Bye.
All
Thank you.
right. Thank you.
Thank you
Bye.
very much.
Bye.
Thank you very much.